Hey guys, what is going on? Welcome back to the channel. Again, I want to thank everyone for your support on the channel. All the viewers, all the subscribers, immensely appreciate the support. Today, I want to talk about the price of stocks with regards to whether a stock is considered expensive or cheap. I thought I would do that in the context of talking about Walmart and a few other related companies. Walmart has been in the comment threads of recent as a stock that has pulled back quite considerably and maybe is a very good stock to pick up cheaply on discount. If we take a look at the graph over the past 1 day, past 1 week here, you can see down 4.2%, and past 1 month, down 12.3%. A lot of viewers on the channel have been suggesting that this is a very cheap stock at the moment and can be picked up at discount. So let's talk about exactly what determines whether a stock is expensive or cheap. And it really has nothing to do with the price of the stock. So for example, WMT here is $92.83, while Amazon here is $14.99.80, briefly getting up over $1,500, I believe, at one point. Yeah, $1,522. So you may be considering that Amazon is much more expensive than Walmart. But if we take a look at some other metrics with regards to what it means to be expensive, it's not simply the value of the stock. It's more of how much value are you getting out of earnings for each dollar you put into a company. And there's a very easy way to look at that, a very simplistic metric called the PE ratio, price to earnings ratio. I've done quite a few videos on this before. Please take a look at those videos. But I thought I'd kind of go over this once again since there's a lot of new viewers on the channel and there's been a lot of discussion about what makes a stock cheap or expensive. So you can see here Walmart price to earnings ratio is $28.407. With earnings on the bottom here, you can see $1.36. So really, price to earnings is simply the price of the stock, which currently would be $92.83, divided by the earnings for each share of a stock. And that's considered over a total year. So you can see the four quarters on the bottom there, Q1, Q2, Q3, and Q4 2017. You'd simply add all of those up. The last one there, the actual EPS being $1.33. And then adding up each additional one, and that would be the denominator in that equation. So the E in the PE ratio, the price again is simply the price of the stock at any given moment. And that'll change depending on the price of the stock. If the stock price starts going up, you can see that price to earnings ratio will also go up as well. If the price of the stock goes down, that price to earnings ratio, PE ratio, will go down as well. But again, it takes into context the earnings. So yes, a stock price does play a part into how expensive a stock is, but it's more of the denominator there, the E, how much earnings are you getting for every dollar you put into the company. So for example, Walmart here, for every dollar you put into the company, you can see $28.407 would equal $1 of earnings. So you need to put $28 into the company essentially to get $1 of earnings. If we take a look at Amazon, again, irregardless of the price of the stock up on top there, you can see this PE ratio is much, much larger, 244.224, which means that for every $244 you put into the company, you get $1 of earnings. So you can see that this is a much more expensive stock than Walmart here. Again, you put in $28 into the company, you get $1 of earnings. For Amazon, you need to put in $244 to get that same amount of earnings potential back. And again, that's all calculated on the price of the stock as well as the earnings here. Again, all four quarters added together would be that denominator or E value in the PE ratio. So you can see here, regardless of the price of the stock, the PE ratio is determining whether a company is expensive or cheap. So between Walmart and Amazon, somewhat in the same market segment, you can see Walmart's a much cheaper stock than Amazon. And what this is also telling you is that lots of investors have confidence that Amazon will be having more earnings in the future. They're willing to put more money into the company for every dollar of earnings because they expect in the future that the company will be producing more earnings. Essentially, the company is growing. And you'll see this with a lot of growth stocks as well. Amazon, Netflix, Google, for example, here, GOOG as well. You can see that the PE ratios are quite high. And the other caveat too is, and this is why I brought up Google here, you can't compare against different market segments. So you can't necessarily compare an Amazon against a Google because they're just two different market segments. So consumer discretionary versus materials, for example, or industrials, you can't do that. Financials, versus other market segments. You can't do that because it's only within that particular market industry that the PE ratio can be compared against each other. So you can't compare, for example, a Ford PE ratio less than 6 against Google or Amazon here. They're just simply different business sectors, different ways of evaluating a company. That makes sense. So yes, the price of the stock does play a part in the overall value of a stock, whether it's cheap or not, but I would take a look at the PE ratio more than the price of the stock alone. And again, with Walmart, coming back to this first example here, a lot of folks think this is very cheap right now, down 12.3% over the past month, getting in on the dip. But if we take a look at the 3-month graph, and more importantly, the 1-year graph, you can see this stock is still up over 1 year, 33.49%, which is absolutely remarkable here. 33.49% over 1 year time span. Over the last 5 years, you can see it's only up 50.04%. So really, this past year accounts for the majority of that increase in the price. And yes, it has come back a bit, but it's still up quite a bit, 33.49%. So I would say this is a somewhat expensive stock, but much cheaper than an Amazon here. Again, regardless of the stock price, because of that PE ratio there, 244. If we take a look at Amazon here, you can see it's up 77.56%. Again, over only 1 year of elapsed time, 461.85% over the past 5 years. So a lot of investors have confidence that Amazon will continue to grow and really cannibalize some of the market share from other companies like Walmart and other competitors like Target as well. And then also I wanted to take a look at Tesla, because this is a very unique situation, which this is a growth stock. You can see the tremendous growth here, 39.29% over the last 1 year. And over the last 5 years here, you can see, if it pulls up, 873.55%. So you would think that this is a very profitable company, but you can see here the PE ratio says NA. It cannot be calculated, and that is because the PE ratio is essentially infinity. You can see that the earnings is a negative number. So if you were to put in the price to earnings ratio, you'd put a number almost equal to 0 on the bottom, which would make, no matter what the price of the stock was up on top, the P, even if it was 1 penny, an infinite number there, just because the company does not produce any revenue. So for every dollar you put into the company, you'd essentially have negative earnings. You can see on the last quarter there, quarter 4, 2017, negative 3.12. So for every dollar you put in the company, you would have negative earnings because the company currently is not making any earnings. But there are a lot of people putting money into the stock because they think over the longer term, the stock will continue to grow and at some point start turning a profit and be very competitive, have a durable competitive advantage against its competitors. Or that's the thought, at least. And that's what really makes investing in growth stocks like this a little bit more risky than your traditional blue chip stocks that have been around for quite some time. Really growth versus dividend type of stock. Capital intensive stocks can also work the same way, but really there's two different types, kind of income dividend stocks versus growth stocks. Growth a little bit more risky, but again, with risk comes reward. So I hope that helps you guys kind of configure your thoughts when you think about whether a stock is expensive or not. I take a look at the PE ratio typically. Again, PE ratio is only good within the same market segment. You can't compare two different companies from two different market segments. And the PE ratio is also very good because it takes into account earnings, not only the price of the stock, whether the price is going up or down. The PE ratio will also be affected by the earnings, which can vary considerably as well, and really determine whether a stock is expensive or cheap. So I hope that clears things up. Again, on Walmart here, it may look like the stock is very cheap right now, 12.3%, but if you take a look at the 1 year graph, it is still up 33.49%. I'm thinking maybe getting into Walmart if it does dip down to maybe 85 or so, down to this level here. You can see really over the past year, it has had tremendous growth, and really over the last few months here, spiking up over $110, I believe, at one point, or very close to $110. So that is how I take a look at stocks when I consider valuation. Take a look at PE ratio. There are a number of other metrics out there as well. Please take a look at my videos talking about PE ratio. I do go into some of the other more sophisticated numbers as well. Again, looking into whether a stock is expensive or not. And the other big caveat too is that when a stock is more expensive, when the PE ratio is much higher than a typical dividend or income stock, the price of the stock will vary tremendously with very little news in the market. With Walmart here, for example, you can see that the earnings here expected 1.36, actual 1.33, so it missed earnings by 3 cents. But because of that, the stock plunged 12.3%. So I do think that there was an overreaction in the market with regards to Walmart. But again, over the last 1 year, not quite sure if it is at a value that I would get into at this moment. If it does dip down to 85 or so, I would be inclined to pick up a few shares of Walmart. But again, I am not a professional investor. This is simply my thoughts and some of the research I've done on looking at evaluating stocks with regards to valuation. So let me know what you guys think about PE ratio, whether you guys use that in determining whether a stock is expensive or cheap, or if there are better metrics out there. Please let me know. Again, if you guys have any questions about this video, other videos, please let me know in the comment threads down below. And kind of with that, I'll end the video, and we'll see you guys next time.